Okay, let's take a look at this return on investment analysis problem, problem 10-14A. On the screen to the left of where I'm moving the mouse, you have a contribution format income statement for Williamson for last year. And the company had average operating assets of $4 million during the year. And there's a number of requirements that we need to address. We need to compute the company's return on investment using the ROI formula stated in terms of margin and turnover. Now, right here to the just above my mouse, I've indicated that ROI is equal to margin times turnover, and then we can break that down into net operating income divided by sales, which is the margin, and multiply that times the turnover, which is sales over average operating assets. Okay, so with that, let's tackle the first requirement. First off, we need to come up with what the net operating income is, and the net operating income is given to the number to the left of my mouse, right there. So it's equal 800,000, and then we need to divide that by sales, which is 8 million. Okay, turn that into a percentage, and let's take it to, maybe just one decimal place. Right? So there's our margin portion of it, the first term. The second term is the turnover, and the turnover is equal to the 8 million divided by average operating assets, which they give you right above my mouse there, of $4 million. Okay, so that, and we'll take that to 2 decimal places, is equal to 2. If we multiply those across, we come up with the ROI. So I'll go right here, and we'll multiply those two. Take that cell times that cell, and we can turn that into a percentage. We'll take it to 1 decimal place. And the answer, which I'll turn bold to part 1, why don't I just label this number 1, is 20%. So we've computed the first requirement. Okay, now I'm going to slide the second requirement on our screen, and we can solve that too. Hopefully it will fit it in just nice here without losing any data. Yeah, that'll work just fine. Although we could probably slide it just a little bit, get that a little bit more centered. Okay, so let's look at number 2. Number 2 says, using just-in-time, the company is able to reduce the average level of inventory to 800,000. And the released funds are used to pay off short-term creditors. So now, can we solve the same question, the ROI, with case number 2? Okay, well, in terms of net operating divided by sales, nothing changes, right? We still have the same 800,000 divided by 8 million that we see right there, so we'll just copy that down. But now what's different is we have 8 million, and instead of having 4 million of average operating assets, we're able to reduce it by 800,000. So we can divide that by 3,200,000, or if we didn't want to do the math and we wanted Excel to do it, we would take the 4 million and subtract off the 800,000 reduction that's given in the problem. And so that number then, let me format this, goes to 2.5. If we copy this down, we get the multiplication using Excel, and we come up with 25%, which represents an increase. So in all of these, we see that in this case, there is no change. In this case, we've got an increase, so as a result, the answer is an increase for case 2. Okay, now let's slide case 2 out of the way, or requirement 2 out of the way, and let's slide case requirement 3 in. And we'll slide a little bit here. I'll put number 3 here. Okay, now the company achieves a cost savings of $48,000 per year by using less costly materials. Okay, what do we do here? All right, now I believe we're operating back to the base case. So we start at the information we have here, and then we consider the changes here. All right, what's different here? First off, I want to, let's just copy all of this here because we have it there, and then we can edit it, and that way the formatting is correct. Okay, so now instead of 8 million in net operating income, we actually have the 8 million, but we have an increase in operating income by the cost savings of $48,000. Okay, so as a result, we go from the base case, we're comparing 1 to 3, of an increase, if you will, in case 3 from 10 to 10.6. Okay, now nothing else changes in compared to the base case. We still have the same amount of inventory. So if I copy that one down, we still have the 8 million of sales divided by average operating assets of 4 million. And then when we multiply that across, we get 21.2%. So here we have no change, and over here we have an increase. Okay, and maybe I ought to capitalize that and try to keep this consistent. Okay, and that takes care of case 3. All right, now let's slide 3 out of the way, and let's bring in requirement 4. And requirement 4, that fits in there pretty well. We'll slide down a little bit. Hopefully we won't lose too much of what we need above. And again, I'll put in 4. We will copy from the first case because we're always comparing to the first case, so that might be the best one to copy from. 4 says the company issues bonds and uses the proceeds to purchase $1 million in machinery and equipment at the beginning of the period. Interest on the bonds is $120,000 per year, and sales remain unchanged. The new, more efficient equipment reduces production costs by $160,000 per year. Okay, first off, the $8 million doesn't change, but we do get a change in operating income. And the operating income, we wound up with $800,000, but now we reduced costs by $160,000, so operating income would increase by that $160,000. Okay, now remember that operating interest is not considered an operating cost; it's considered a financing cost, so it gets excluded. That number goes to 12%, which represents an increase. Now over on the turnover side, what we have is 8 million, but we can't divide it by 4 million because now the operating assets have increased. And what we have is, let's see, 1 million equipment at the beginning of the period. So we've got an extra million in there. So let's go ahead and bump up the 4 million plus the 1 million increase, right? And that goes to 1.6, so that represents a decrease. And as a result, we wind up with a net decrease down to 19.2. That takes care of number 4. Okay, now let's slide number 4 out of the way and bring in requirement 5. And then we'll slide a little bit. Well, first let's read it. As a result of more intense effort by salespeople, sales are increased by 10% and operating assets remain the same. Okay, I'm going to copy all of this over. Turn that to number 5. And sales are increased by 10%. So we've got an impact on the bottom. And if sales increase by 10%, we've got a couple things we need to figure out. I'll tackle the easy part first. First is the sales. If it increases by 10%, we can multiply this times 1.1 to come up with the new sales figure. But we're not done yet. That also means we need to multiply it times 1.1 to come up with the new numerator dealing with the turnover side, right? So we've dealt with sales on the margin and the profits. But what we also know is if sales increased, we've also had an increase in profits. So let's produce a real quick schedule here. Okay, what we know is, let's slide back up here. Maybe we can see it. Sales are 8 million, variable costs are 5,600. So let's jot in some of that information in the. I want to do it in the base case. Okay, we have variable cost, and I'll just abbreviate, and I'll round this to thousands. Now let's do it in millions, so that doesn't get confused. Okay, so we've got millions, and then we got variable expenses to the left of my mouse of 5,600. So 5,600. Okay, so we have contribution margin. I'll just abbreviate here, equal to 8 million less the 5,600. Okay, on a percentage basis now, we know that that would represent 100%. Okay, I just want to break this down, 70% and 30%. Okay, hopefully you all see that. All right, so now if we've got an increase that goes to 8.8, we can expect the variable cost to be equal to the same 70%, since costs haven't changed in this scenario. And therefore, we've got a change in contribution margin that is going to fall to the bottom line. Okay, now fixed cost would be the same either way. Okay, I'll keep working the schedule here. Let me just open this up so you can see that a little bit wider. Okay, and the fixed cost we're given right there of 1,000,006, or fixed expenses. I'll abbreviate that, of 1,000,006. Okay, that 1,000,006 isn't going to change, right? It's a fixed cost. Now, we could compute the net operating income. It's going to be 800,000 here. But what we really need to know is what's our new change in operating income. Now, let me slide so we've got a little bit more room to see that. Okay, so I'll abbreviate that. That would be equal to the contribution margin less the fixed expense. So that goes to 1,040,000. Well, now that we know that, we can go back to number 5 and recognize that that 800,000. And let me just jot it down so you can see where it's coming from. Okay, so we had 800,000. It goes to 1,040,000. So on number 5, we know that the numerator also has an impact, and that number becomes 1,040 divided by our 8.8 new sales number. Over here on sales divided by operating assets, we already have the sales, and I believe operating assets under this assumption, it remains unchanged, as it says just to the left of my mouse. So what we see in number 5 is we wind up with, comparing to base case number 1, an increase in margin, okay, an increase in turnover, and as a result, a return on investment has an increase. Okay, that takes care of number 5. All right, we'll move number 5 off, and we'll bring in requirement 6. Okay, requirement 6 says at the beginning of the period, obsolete inventory carried on the books at a cost of 80,000 is scrapped and written off as a loss. All right, let's copy this here. We'll take a look at number 6. Okay, and that little schedule pertained to number 5. So let me just draw a line underneath it so we can tell where number 5 starts and ends. I'll do it right here. So you can see that's 5. Now we're working on 6. Okay, so number 6, the difference is that 1,000 lost as a result of scrapping obsolete inventory. Well, that's considered an operating expense. So in terms of determining the margin, the 800,000 would be reduced by that $80,000. Okay, so we've got a reduction here down to 9%. And we have no change on sales, but we do have a change in terms of the operating assets because that inventory was scrapped. And we assume it's done at the beginning of the year, which makes the calculation easy because the average is beginning plus ending divided by 2. If the change occurred at the beginning of the year, then it was in effect for the whole year. We can skip the averaging and just reduce that $80,000 off of the base, right? And then that goes to 2.4. So as a result, we've got a decrease in margin. We have a decrease, an increase. We're comparing it to number 1, which was 2.0, but the net effect, the impact on the margin had a greater impact than it did on our turnover. So as a result, ROI goes down slightly to 18.4%. That's number 6. Let's move that out of the way. Move in number 7. Number 7 says at the beginning of the period, the company used $180,000 of cash to repurchase and retire some of its common stock. Okay, let's slide so we've got some room. We'll copy this here. I'll draw the line again just so we can see that we're working on number 7 here. And we'll take a look at what happens. Okay, given the transaction here, let me slide back up. And we can't see it there, but we can see it here. The company uses $180,000 of cash to reduce common stock. Well, that has no impact on margin whatsoever. We still remain the same at income of $800,000 on $8 million of sales. So there is no change here. Okay, but in terms of net operating expenses, we have no impact on sales. But think about net operating cash. We've got a reduction of $180,000 in cash. Okay, so we reduce $180,000 off of the base. We go to 2.9. That represents an increase, and as a result, we see an increase in return on investment. And that's the 7 cases of this problem, everyone. Thank you.